Hello, ladies and gentlemen. This is Modern Investing on Pod TV. My name is Sasha Starr, and my guest today is my friend and wonderful person in many ways, Milan Sombarak. Dr. Milan Sombarak, welcome to the show.
Delighted to be here. Wonderful person in many ways. I got you fooled. Looks good.
Thank you, Milan. One more time, congratulations with this wonderful tournament that my wife and I played with a great enjoyment as always, and many other people, I'm pretty sure, enjoyed this event, and it will be even better next year. So,
The viewer should know that Sasha and his wife both won their divisions in the tournament. Sasha's wife, Nava, is the 8th-time Canadian women's champion, and she proved this weekend. And Sasha did very well too. He won his division.
thank you so much, Milan. And now let's come to the investments. And what's happened today is the market is in indecisive mode. The Dow is a little bit higher, the S&P a little bit lower, Nvidia all over the place. It's now minus two something. It was in plus, it was in minus. I think the stock market is a hostage of Federal Reserve right now. And the moment they say that interest rates will not be changed, it's not very good for the market. Now there came this noise that actually they may even raise interest rates this year. And that's horrible news for the market. But anyway, market is still where it was before a couple of days ago. So nothing really big things happened. Milan, I would like to clarify one issue that we were discussing in the last few programs is the idea that when you are buying somebody's shares, you are buying it from somebody who is probably knows more about that stock than you do. That's possible. I'm no argument about here. Although in some cases maybe you know more than the one who sells you the shares. However, what's very important to understand that the company which shares are being traded back and forth and somebody's buying, somebody's selling, it has no virtually effect on the company itself because the company doesn't change that much from, let's see, you are selling some shares and I'm buying some shares. And it doesn't matter, I'm buying it from you or from somebody else. Or you are selling it to me or somebody else. It doesn't affect the company itself. So there were a lot of talks yesterday about this students' protest, that what they're trying to have their university endowment funds to divest from Israeli companies. First of all, I have several issues that the student protests are now evident all over the world. So my question is how you see it, Milan, that all students in the United States, in Europe, in Asia, in Africa, in Latin America, everywhere, they're all determined to ask their endowment universities fund to divest from Israeli company. How has that happened? I mean, how people in all over the world can come up with the same not even controversial issue. To me, it's non-issue at all, because if this endowment funds will divest themselves, which means selling shares of Israeli companies, so some other investor at the same time will buy the shares of Israeli companies. So Israeli company will not even feel that the some people sold shares and some other people bought shares. It doesn't affect the Israeli company. So what, in your opinion, this idea is all about, and why is it so important for these protesters?
I never understood the student protests because in dentistry, like in medicine and engineering and in architecture, we had 50 to 60 hours of lectures and laboratories. We were there on Saturdays, we were there in the evenings, we had no time for protests. Now, when you take a look at who is protesting, it's generally art students who have, listen to this, good thing you're sitting down, 16 hours a week of lectures. They had lots of time to do other things like protesting. Now, protesters probably brought the war in Vietnam to an end,
Yeah.
probably did. And so I have to say that they can be useful socially in many ways, but not having a minute for that kind of a thing when I was a student, like the engineering students, medical students, architecture students also don't have a minute for protesting. I can't really make an intelligent comment on that. Now, you're talking about endowment funds. Let's talk about that for a minute. The most successful endowment fund is the one that's run by David Swenson, the late David Swenson of Yale University. Harvard has a larger one, but Yale's is the fastest growing one. And so David Swenson said that security selection and market timing make no contribution to returns. He also said asset allocation it contributes more to returns than anything else. And when you look at the on an after-tax basis for a long enough period of time, and there would be about a decade, there's hardly a chance that you will beat an index fund. So I sound like a broken record because I keep saying this every time we're together. Don't buy individual stocks. Buy the U.S. market as a whole, which itself has had the best track record for over 100 years, close to 200 years. You're buying the American economy. Empires have a 100% failure rate, but the failure of the American empire is nowhere near in sight yet. Someday it will be. We're going to have, within the next 10, 20 years, we're going to have 3 major recessions where the market will drop 30% in a year, as it has done previously. We have to take that into account in our investing and not put into the market the money that we're going to need in the near term. Having done that, we will get the best returns of any investment, generally speaking, unless you are cherry picking. There have been stamps, individual stamps, that have done much better than the market. There have been individual paintings that have done much better than the market. Everybody knows Stradivarius violins. It's a name that everybody on the street knows. The Stradivarius violins, top one, just sold for, I think, $16 million. That was worth $1 million maybe 50 years ago, 500,000. Most people don't know about violin bows. Violin bows, the violin bow equivalent of Stradivarius is a French bow maker whose name is Tourte, Tourte. A Tourte bow weighs 63 grams, and it can buy 2 Steinway grand concert pianos. Now, if you were in the business of selling music equipment, would you rather sell a 63-gram bow or deal with Steinway grand piano, which you have to take the legs off to move it and tune it and retune it and so on? If I were in the music business, I'd get out of the piano business entirely and just stick with bows. Yeah.
I would prefer to have a grand piano steel and maybe a cheaper bow.
Hey, Milan, and a couple of things. One is I have friends that are in the arts, and I can tell you that a lot of them are taking more than 16 hours of courses, and all along those lines, they may be doing what they call liberal arts, and they may be doing a mixture of those courses that are in their field, because I know that even at North Carolina Central University and at Duke, there are a number of people that are taking the music courses, and they are definitely doing more than the 16 hours that the both of you gentlemen were saying, and all along those lines. But I did have a question about endowments, because before we started the show, I had mentioned that I had gone to the Nasher. It's one of the premier museums in this area, and it is connected to Duke University and all along those lines. But you can make an endowment at the Nasher Museum, and there have been a number of people that have made endowments in the nature of millions of dollars and all along those lines to support the people, collections, and programs of that museum in perpetuity. And like I said, it is wide range, everything from European art to art from Africa and every place else that it is far and in between and all along those lines. But what is y'all's thoughts about endowments as a form of investment for those that want to go into the endowment business. Because I know that even some of the nonprofits I've worked with, they set up endowments in order to keep themselves afloat. So just wondering your thoughts around endowments in general.
Milan, would you
So
like
your
to?
question is, what should endowments invest in?
What is the benefit of endowments, and should people be looking at endowments if they are lovers of the arts, lovers of music, and a number of other things?
No, I don't know how to answer that question, Mark. I have several friends who are university professors at the University of Toronto Dental School, and so they're constantly asking for contributions. The endowment is huge. And when I ask them, has your personal income gone up in the last 10, 20 years? And the answer is no, it hasn't. Where's that money going? I have no idea where that money is going. Is it going to help students pay less? Interestingly, the Albert Einstein School of Medicine in New York City recently became tuition free because one of the professors there, one of the ladies, was married to a Wall Street guy who died and left her with several billion, that's with a B like in Bravo, $1 billion, and said to her, I know you're going to do something useful with this. So she goes to the dean of the school and said, what am I going to do with this money? And he said, why don't we make Albert Einstein Medical School tuition free? So now, how many applicants are they going to be facing when they know the applicants, all of whom are qualified, that if they get in, they're going to get in there and not pay tuition? You know, the average dental student today graduates with a debt of $300,000 average. I think it's a terrible indictment on Canada and the United States, the wealthiest countries in history, that our students have to pay so much for a university education when all the Scandinavian countries educate their students at the expense of the country. Educated people earn more, which means educated people pay more in income taxes. So it really, by educating people, the countries that do so can consider that as an investment. They're going to get that investment back as a return in higher income taxes that these people are going to be paying. All communist countries, some of them dirt poor, like Cuba, for example. You can get an higher education at no charge.
Free medicine, by the way.
Free medicine.
Medicine education as well.
So why is the university education so expensive in the United States and Canada? It's really shameful that it's that way because these are wealthy countries.
Yeah, they're definitely wealthy countries. I'm going to turn it back over to you and Sasha, but just really quickly on that endowment question, I can tell you that the Nasher says that the growth of the endowment through investment return and charitable giving enabled that particular museum, and other museums do the same thing, to provide internships to students, build the permanent collection, because they do have a permanent collection there, organize significant exhibits, and launch new academic and community programs that support a wide range of what they call important needs. So it does look like they try to use it as a way to invest and to keep some things in there that are permanent, including some internships for those students that may not be able to afford it otherwise.
Makes sense, Mark. Makes sense. Admissions to those exhibitions don't cover costs.
Well, I would like to add something that the real purpose of endowments, if properly run and successful, of course, they provide the economic financial structure to benefit, at the end of the day, all students. I'm not talking about free education like it's happened in the medical school of Einstein, but general, to provide more stipends for students or some other encouragements. And therefore, I'm surprised that the protesters, actually, they are proposing to divest from Israeli companies without realizing that a lot of Israeli companies are on forefront in the area of artificial intelligence, high tech, and they're doing, most of them are doing financially very well. So to divest that, it means that this money would be invested in some other instruments, shares of other companies, which may not be, and most likely will not be, as successful and well doing as Israeli companies. But again, this is, in my opinion is more political movement rather than.
No, it's definitely an anti-war movement and everything. But Sasha, just really quickly, do you think that that would be the same argument that you would have made with South Africa? Because they did ask people to divest of money from South Africa during the height of apartheid, and some of those companies actually did divest from South Africa. And there are some people that argued. They can make the argument that that is part of the reason that apartheid ended. I mean, there were other things that were factors as well, but they are saying that some of that economic impact could have been the reason, and that may be what some of these students are thinking, that if they die in
Mark,
divest.
Mark, again, it's a political issue rather than financial or economical, because you know that half of the gold known resources, they are in South Africa. And South African companies are doing quite well. Now, the apartheid ended in South Africa many years ago. Is South Africa today is much better off than it was before?
There's a good question. There have been some articles in the New York Times and the Wall Street Journal showing that South Africa was better off with Nelson Mandela there than it is today.
Most
Yeah, but
likely.
then Nelson Mandela was after apartheid and everything. So, I mean, and there are probably some people that could even argue, if they chose to, that things might have been better under de Klerk. I don't know that I would necessarily agree with them and all along those lines, but they can make those arguments and all along those lines. But definitely there are things that happen in the sense of political, and sometimes people do use economic tools as part of their political conversations. I mean, that's been going on forever. That's part of the reason for the sit-ins here in the South and all along those lines.
The
I
main
haven't, you know, Milan, I haven't heard about many Americans living in the United States going to South Africa. I've heard about some Americans who are going to Russia and to live under Putin. So that's a very interesting phenomenon. I think that they will stay there for many, many more years.
There aren't many. There aren't many. Certainly, it's not something that's collectively done. And the real issue here with a lot of these developing countries is that the best people leave for the sake of their children, grandchildren, and for the sake of themselves. For example, one of our neighbors here is an engineer from South Africa who is doing very well financially. But it's people like that who could help South Africa and countries like that turn around, except they leave for the sake of their children and grandchildren, which totally makes sense. The minute somebody qualifies in any major occupation, let's say engineering, medicine, and so on, they start looking at how to get out of that developing country and move to one of the Western European countries or Canada or the United States. But something interesting here, that's a bit of an aside, is that when I graduated in 1965, if I had invested $1,000 in the American stock market, as shown by an exchange-traded fund which tracked the S&P 500, I would have about 300,000 today. 1,000 invested in 1965 would be about 300,000 today. Had I invested in Berkshire Hathaway, I would have $54 million. Now, had Warren Buffett charged the usual 2 and 20 fee, I would still have over $5 million. So,
Hey, Milan and Sasha, before I bounce and everything along those lines, I do have a question. Do either one of you two have just possibly laying around in your household $1.6 million? Because I did see that the house, and you know, if you follow sports movies and everything, there's a very popular movie called Bull Durham, based here in Durham, and the house that movie was set in, the house that the characters supposedly consummated their love in, and all along those lines, and they actually met and were real life partners, that being Susan Sarandon, who, by the way, is very politically active in all of that stuff, and Tim Robbins. It is now up for sale, and they did some renovations and other things, and that's all they want. They just want a cool $1.6 million. So I know I don't have that, but I was thinking maybe the two of you gentlemen just had that laying around and might want to buy this nostalgic house and everything along those lines.
I would make a bet, or rather offer, for 350,000, and if I can get it, I'm okay. But
So you make a counter bet. You make a counter effort of ridiculously that's much lower and everything. That sounds like
yeah, I think it's much lower, but that's where I am. Sorry to say so. Now, Milan, coming back to your proposed S&P investment in the long run, yes, it's very solid investment, and I'm very, very impressed that you have knowledge, discipline, and insight to follow that path. You know, I have no problem with that for your core portfolio. Now, for fund portfolio, though,
Yeah.
I came to the conclusion, and it's elsewhere you can find it on the internet, that most of the movements in S&P 500 belongs to Magnificent Seven
Yeah,
stocks,
Yeah.
and the rest 493 stocks, they are just, some of them are going higher, some lower, and something like this, but there's no really large movements except those Magnificent Seven.
A couple of things I'd like to say about that. First of all, I'd like to know why David Swensen and Warren Buffett aren't listed in that book, Market Wizards. Now,
I would think that there is no wizardry of anything to put some money into Coca-Cola and some other solid stocks for 55, 60 years and sit on it. But I don't think that anyone can be declared as a wizard by doing that, and that's why probably they're not in a book. Now, but if you have a discipline and you don't divest yourself and keep the course, but lately, as you know, Warren Buffett, he bought Apple, and before he was saying that he doesn't understand high-tech stocks and he will never buy one, but then he bought Apple. So I read, oh, Warren Buffett bought Apple, but then he sold a big portion of Apple stock. But again, we know all that once it's already happened. We don't know that he's planning to sell a major position in Apple. We know it's.
Well, a couple of things about that. First of all, most of the decisions made by Berkshire Hathaway previously, before Charlie Munger died, were based on Warren Buffett and Charlie Munger buying companies. They were not market wizards, they were business wizards. And they bought companies, many of which are traded on the stock exchange, so it looks like they're picking stock.
Milan, let's be very careful and let's clarify what means to buy a company. To buy a company means that you are becoming a major shareholder of the company.
Yeah, right.
When Buffett made up his position in Apple, nowhere even near he would be a major shareholder. So he didn't buy a company. He bought a position in the company, not a major position, but substantial positions because of sheer size of his investment. Obviously, it was a large position, but he didn't buy a company.
Well, Sasha, maybe he didn't have much to do with that decision because there are others there now who are going to replace Buffett when he is not around anymore. And so he is chosen several people, and one who has a major role in the operations of the company, his name is Abel. Isn't that a nice name to have for the job that he has? And he's a Canadian, and he plays hockey every day, the real Canadian guy. But some of these decisions are made by people other than Buffett now. So I think that's what it is. Now, there are three things I'd like to say about a fund portfolio. Three things. Number one is nobody needs one. Number two is if you have a fund portfolio, make sure that it's of a size that if you lose it entirely, it will not change the way you live. It will not change your lifestyle. So it has to be small enough. And number three is don't keep records because you were sure to be disappointed. It's almost for sure that you cannot beat the market as a whole. Yes, people have done it. There are outliers out there that have done so, but by and large, it cannot be done. So, I'm talking to people, let's say, who have been doing this for a while. Instead of don't keep records, take a look at your records going back 10 years. If you've been doing that for 10 years, almost for sure, you have not equaled the S&P 500. So those three things.
My record showing that no, I did not equal S&P 500. I beat it by generating profit for 12 months of 188%. 100% verified. So therefore, I'm not so sorry for myself to look at the records. Actually, I'm very proud to look at my record. Number two, I'm not going to give away my gains so easily, because that, looking at my track records, helps me to get into a very sophisticated strategy of always increase my gains and cut my losses very quickly. You know, the famous investor William O'Neill, unfortunately deceased, but he was behind. He was founder of Investors Business Daily, which has been recently sold to Dow Jones, and he made several years ago, say 25, 30 years ago, he made two incredibly practical advices. Number one, if you bought a position and it lost 7% from the point where you bought it, you sell. Then you can ask questions. Oh, maybe it will recover, maybe it will do something else, maybe it's a very good company. Do that afterwards. First sell. Then you can study the situation with the stock. And if you are wrong, let's see, it lost 7% and it didn't lose another even 0.5%. From that point on, it started to recover and going higher. So you buy it. Okay, you lose.
You know, what you're saying here applies to individual stocks, and we recommend against purchasing individual stocks based on David Svensson's recommendations. We recommend that people buy the American market as a whole. And when it drops 7% or more, we recommend people buying it because it's a bargain. And so what happens if you are in the American market as a whole by using an exchange traded fund which tracks the S&P 500, and SPY happens to be the best because it's the oldest, the largest, has the narrowest bid-ask spread. If you have that, then as the market rises, to rebalance your asset allocation to whatever it is, that's not that important, but let's say 50-50, you wind up taking profits. What happens in reality when the market rises, most people are jumping on board when everything is expensive. Conversely, when the market drops, the S&P 500 drops, we recommend that people, in order to rebalance their 50-50 asset allocation, they buy bargains instead of running away. And so in reality, what happens, most investors, when the market is dropping, are running for the doors instead of buying bargains. So our method, which is American economy as a whole, using an exchange traded fund which tracks the S&P 500, and rebalance your asset allocation when it's thrown off by market movement. And your market asset allocation could be 50-50, 60-40, 55-45 is not that important. The important is to maintain it. And so the result is you're always buying bargains and always taking profits, the exact opposite of what most investors are doing. Most investors are losing money on the market, aren't they? They're not doing as well as the market, I mean. They could be making money, but...
I have no idea, because what I'm doing, and it's very difficult to have this conversation, because what you are talking about, your core portfolio, it has nothing to do with the fund portfolio. Now, what's happened with individual stocks, if you look at this book, which I showed quite a few times, Market Wizards, all of them made fortunes in trading either stocks or futures or commodities. And averaging down, it's a losing strategy on individual stocks, not on S&P. With S&P, there is always time, 6 months from now, a year from now, 5 years from now, it will recover. And I believe in this theory.
Yeah, well,
you will recover for a while, but it will. But I'm talking about fund portfolio. I'm talking about individual stocks. I'm talking about Magnificent Seven. I'm talking about NVIDIA in particular. I'm talking about something that you can differentiate between acceptable market return of 6%.
You're talking about
for much bigger returns. And
you're talking about here about outliers. You're talking about the Mozarts of investing. You're talking about investors who are not the average investor out there. You're talking about exceptionally talented and skilled people, which certainly does not apply to people like you, like me, but you are one of those market wizards. You're a Mozart in investing, on the piano too. And so the average investor does not equal the market. That's very easy to look up. And so you're talking about outliers here, which most of us are not.
But Milan, here comes the question. What would we like to achieve in our program to serve an average investor and help him just make average returns? Do they need our program for accomplishing that? I'm not so sure.
Well,
Or we should explain what we are doing to differentiate us from average market participants.
Well, if they want a discussion about fund portfolios, then they need to watch this program. The other thing is that we can show in this program, there's no need to have a fund portfolio, just buy the American market as a whole. And so history, they say history does not repeat itself, but it rhymes.
Okay, I mean, how about that? What if you will start program and 5 minutes we will talk about investing in S&P 500 and the idea to average down if market goes down and cash out some of your gains if market goes higher, and we can easily get it into 5 minute slot. We don't need any more time for that. What do you agree or not really?
Yeah. I know.
So let's start next week. We will do 5 minutes S&P 500 and merits of this disciplined investor and so on, and the rest, 25 minutes about the fund portfolio and how you can outperform market significantly using options, using selling cash covered puts and covered calls, and therefore you can really beat
the real question here, Sasha, is why would you want to outperform the market when equaling the market is something that you can teach a high school student to do in about 2 minutes, maybe less, and equaling the market will keep people comfortably retired. Say, for instance, most advisors say that we should live on 4% of our portfolio, inflation adjusted.
I'll tell you why.
The market has equaled more than that. Inflation adjusted, the stock market has returned about 6.25%, and we're only going to live on 4% of that. Is there any real need to outperform the market and take the risk associated with it? Because what I describe here, equaling the market, is risk-free until the American empire fails, and that's not going to happen soon. Risk-free.
Okay. I'll tell you why. Because if you want to take 4% out for living, and your profits are 188%, so taking out 4% still leaves you with 184% profits.
Yes.
Number two is once, not the last trip, but before that, we came with Nava to Aruba, to the hotel Rio Antilles, and there was a small casino. And we went after dinner to the casino, and on a 3-card poker, there was a bonus which was keep increasing. It was $2,200 or so. And now I ask, what is this bonus for when you're paying the bonus? And she was told that once anybody has queen, king, and ace of spades, that's where we pay, on top of the usual winnings, we're paying also the bonus. The first hand that I got was queen, king, ace of spades. It took them 15 minutes to calculate how much I won and the bonus and everything else. When I came back to Toronto, I told about it to one friend of mine, chess player. And he started to think for a few minutes. And he said, Sasha, you can't even imagine how many people are dying without ever having the Flash Royale. Think about it.
Yeah.
So people are averaging 6% in this S&P 500 or so on, and they're happily dying and so on, and they don't have Flash Royale. So your time has a limited quantity, because once it's all over and you have S&P 500 and you leave a little bit to your family, and then you're dead and so on. To me, it's very defeatist. It's a losing proposition. I'm not
Many of our, I would say this, Sasha. Many of our members who follow the advice that we give in save. That's number one. Save. If you don't do number one, the rest doesn't count. Number one is save. Number two is do it yourself. Number three is buy the American market as a whole. Number four is buy and hold, don't trade. Number five is do trade if the market movement throws off your asset allocation. And the last one, number six, is avoid complexity. If you can't explain something to a 10-year-old, 12-year-old, don't get into it. Now, if that can provide you with a lifestyle that you have had your entire life as a professional person, who needs more? Say, for instance, if our members, if you suddenly came into an additional 10, 20, $50 million for some reason or other, inheritance, a stroke of luck, something, how would it change your lifestyle? Would it change the way you live?
10 million wouldn't change. 50 million would. I would probably have a private plane taking me to Paris, the best restaurant, for a dinner. Why not? Yeah, it would change something. Not 10 million. 10 million wouldn't.
Well, yeah. So if people can follow our recommendation, which is based on what David Svensson says, and David Svensson has run the most successful university endowment out there, 2,000 universities. He was the number one. If they follow that advice and they can continue living their lifestyle as a professional person, professional people live very well in North America. If they can continue that lifestyle in retirement, what's wrong with that?
No, I never said something wrong with that. And probably majority of people should be content with where they are and what they're doing, and then eventually they'll die and so on. So their children will inherit this mutual fund, this S&P 500, and so on. It's just going against my personal view of life. Mark, what is it?
I had a quick question for Milan, because I know he's a big fan of the S&P, and I'd actually watched a video on YouTube not that long ago. It was actually a Yale professor, but he was talking the fact that the wages have not met or kept track with the S&P. So I was just wondering your thoughts around that, because that's one of his arguments, is that our wages haven't been keeping up with the S&P, and therefore we might need to do some other types of strategy other than the S&P. But I was wondering your thoughts around that, because
that's probably true. Probably when you take inflation into account, even though some people are making more dollar amounts, that dollar doesn't buy as much as it did yesterday.
Right.
So really they're getting paid less. So for instance, if you have, let's say, a return on your investment of 2% and inflation is 2%, you're talking about 100% tax rate. If our income were taxed at 100%, we'd leave the country or we'd start cheating. But when our return on investment is equal to inflation, that's exactly the same as 100% tax rate, people don't seem to mind, or they don't notice. And so that's right. Many people's incomes have gone up, but the purchasing power hasn't because of inflation.
And that's kind of the argument that he was making, and even to something that you've brought up, Sasha, before. One of the other things that this gentleman was talking about, and I may show it tomorrow on the World Edition or on Friday, is this notion that a lot of our public institutions have become basically hedge funds and are not really doing the business of education and all along those lines. So we actually had some radical proposals as to what they could do in order to actually make sure that people were getting an effective education and all along those lines. But he feels that a lot of them are just basically hedge funds operating as education institutions. So I don't know if you agree with him or not, but that's one of his arguments.
Yeah.
Mark, don't start with education. It's it's very painful question and painful proposition. Maybe we'll discuss it at some other time on another show. However, I would like to thank you, and Milan, thank you so much for today's programs. Long life S&P 500, long life NVIDIA as well. And
Thank you for inviting me. Delighted to be here.
it's always my pleasure. And have a successful week. And we'll see you next Wednesday, same place, same time. Bye-bye, everybody. Good luck.
Thank you. Thanks.